Well, technical analysis doesn't work anymore. It's all complete nonsense. The market has changed. Back in the day, it worked just fine, but now it's all outdated and we need something else. I often hear these kinds of statements from market newbies. And it doesn't matter what market it is, crypto, for example, they'll say it doesn't work in crypto. Maybe it works in stocks, but in crypto all those chart patterns just don't work. Even in the stock market, they'll just say something like everything is outdated. Like Elliott is outdated, everything's outdated. But then how do trading robots work? And really, how do almost all intraday trading strategies work? Those are the ones that trade within the day. After all, neither robots nor intraday trading strategies have any other data except technical data. The answer is simple. Yes, it works. You just need to know how to use it. In fact, good old chart pattern analysis, candlesticks, indicators, all of that works. You just need to understand what to use, where, and how, and everything will start working out for you right away. I decided to make a short course on technical analysis, or I'll show how chart analysis works and how you can and should use it. How the basic indicators work, the ones every trader absolutely needs to know about. And of course, I'll also show you some modern ones from, say, 2025. I'll demonstrate how to use all of this together in practice, both combined and separately. And of course, how to put it all together into a single trading strategy and start making money, basically on any market, maybe even one that doesn't exist yet. This is the first video of the course, and in it I want to tell you what technical analysis actually is, why it basically can't not work, and show you the top 5 mistakes beginners make that lead to losses and disappointment. And, of course, to the opinion that technical analysis doesn't work. And while I'm showing you all this, please like this video and subscribe to my channel so you don't miss the other videos. My name is Maxim. This is the channel Thinking Out Loud. Let's dive into technical analysis. So, what exactly is technical analysis? That's actually a very interesting question. And most people, I think, would answer it something like this. It's chart analysis, levels, lines, indicators, candlesticks, and all that stuff that's technical analysis. And that's certainly a correct answer. But getting bogged down in the details doesn't let you grasp the essence and leads to the very first mistake all beginner traders make. I think that first and foremost, when analyzing the market, you need to ask yourself, why should the price even bounce off this line, or any line you've drawn on the chart? Whether it goes down or up doesn't matter, but why should it react at all? What reason would there be for that? Think about it. You can even pause the video if you want. Why should the price bounce and react to your line? Have you come up with your own version? Good job. Now let me share my perspective with you. The price reacts to a line on the chart solely and exclusively because the people who see that line on their charts believe that from this level, the price will definitely go up or down, for that matter. And they place buy or sell orders roughly around that level. In other words, they're putting their money where their mouth is, which makes perfect sense, right? If we've decided the price will go up from here, then this is where we should buy. A lot of buy orders start piling up there. Everyone sees this, adds their own orders, and voila! Magic! The price really does bounce off this level like a ball and goes up. It's just crowd psychology. That's why it always works. You don't just need to look at the chart, you need to imagine what the crowd of traders is thinking at that moment in the market. Just from a human perspective. Traders are people, after all. Well, not all of them, nowadays there are tons of bots, but overall, traders are people. So it turns out to be a self-fulfilling prophecy. For example, like in Harry Potter, Sybil Trelawney made a prophecy about a child who would be able to defeat that Lord Voldemort, or as it's translated here, Lord Voldemort. I wonder, are Dementors about to burst in right now? So, he got so scared of losing his power that he went to get rid of the problem. In essence, he tried to kill all the babies who fit that description, including Harry Potter himself. And it was precisely through this action that he created a Horcrux and put a part of his soul into it, actually making Harry strong. In the end, if Voldemort hadn't reacted to the prophecy, Harry Potter wouldn't have gained his power and would have just been an ordinary child, with no chance, motivation, or even the strength to defeat the villain. Just think about that for a moment. And technical analysis is exactly the same kind of self-fulfilling prophecy. It's really important to understand this in order to avoid the first mistake beginner traders make. I call it the "I'm the smartest kid in the room" mistake. It's when a person starts looking for some clever levels and tricky patterns. And they're like, aha, I spotted this here, and I noticed that there. Unbelievable. I just discovered a new pattern. And for sure I'm going to make money off all these suckers who didn't notice it. And by doing this, they end up outsmarting themselves. I wonder, is that even a real word? Whatever. It's kind of like, maybe you've seen those charts with a bunch of colorful lines drawn on different time frames, and it's almost impossible to figure out which one will actually work and in which direction. So here's the first piece of advice for beginner traders. Look for lines on the charts that even a blind person could spot. Here, let me show you. So this is a daily chart of Bitcoin. Why am I showing it on the daily chart? Because I believe that proper chart analysis of support and resistance levels should be done on this kind of time frame, not on something like a 15-minute chart. That's much less effective. That's how it is. But daily and weekly charts will amaze you, just blow your mind. How is it that all this works so precisely? Look, we take some level, I don't know, something like this. Yeah, we draw it through the peaks. See? It's just the first two peaks, then a third one appeared. We're just building an obvious level based on two peaks. Nothing special. And it worked here, and here, and here, and here. But here I'm already showing you a chart that's already played out. But there's also a chart that's happening right now. What do we do here? Well, we take those same two peaks and draw some kind of level, right? By the way, parallel lines always have good odds. So if you try to move parallel levels like this, you see how perfectly they line up in parallel, right? And you can even try, if not by the wicks, then by the bodies, for example, to draw a level, right? These are pretty obvious levels on the daily chart. Basically, almost any trader can spot them. Look, let's scroll through. See how perfectly the levels we drew worked out. I turned off the replay to show you that even when these levels were broken, here they are. Broken, right? They still worked. They worked, but now not from top to bottom as support. Oops, not from above as support, but from below as resistance. See? So these levels, they work. And the more obvious these levels are, the better the signal will play out, because they work only and exclusively because a lot of people see them. Accordingly, following this same logic, the more popular the asset is, for example, Sberbank or Bitcoin, the better graphic and technical analysis will work on it. The second mistake beginners make, in my opinion, is not understanding where a particular type of analysis can be applied, where it will work, and where it probably won't. I call this mistake rushing. After all, everyone starts learning technical analysis from the basics. Usually, it's about trends, channels, support and resistance levels, some candlestick patterns, and people go straight to the market to apply them in practice, of course, to make money. You don't really believe that anyone comes to the market just to learn how to draw pretty colored lines, do you? Of course not. Everyone comes to make money. Well, that's perfectly logical. And they start looking for patterns or levels that work great on the daily chart, like the one I just showed you, and they can't find an entry point. Not because they're looking badly, but because there just isn't one. Right now, at this very moment, there isn't one. They think, okay, so I have to wait for this for a week, maybe even longer. Then comes the entry, then you have to wait another week for it to play out, or even a month, or even 3. Damn, no, to hell with that. I'm here to make money right here, right now. So they move to intraday timeframes, for example, where each candle is 15 minutes. Here, you definitely don't have to wait for weeks for something to happen. And yes, really, you don't. But on such a time frame, levels don't really work. They get broken through in either direction just like that, in a snap, most of the time. And for intraday trading, there are special tools, like understanding how the order book works, the tape of executed orders, what walls are, and special fast indicators designed specifically for intraday trading. And of course, a newbie just gets chewed up quickly there by the experienced sharks of the market. In general, understanding the structure of timeframes and what works on which timeframe is very important. Let me show you in practice. Look, for example, here you have a pretty classic situation, a bullish flag, and the breakout happens on volume. Someone could even count out an Elliott 5-wave pattern here, 1, 2, 3, and 4, basically, yeah. All of this is happening on Lukoil. So, I showed it on Bitcoin before, now I'm showing it on Lukoil. 15-minute chart. And, well, after analyzing a chart like this, someone might, I don't know, maybe somewhere around the breakout from this flag upwards, or basically, right here on the flag, enter with the hope that it will play out upwards. let's see what happens next. And then it won't actually go up, but instead, it'll pull everyone who needs to be in the trade in and then go down. And why is that? Because if you look at the time frame, at least the 4-hour chart, you'll see that this actually isn't a bullish flag, but a bearish one. So it's basically the same pattern, but on a higher time frame, and it's forming a bearish flag. And the person has already gone all in, maybe even with their entire savings or, God forbid, with leverage, because they wanted it here and now. Always remember that the higher time frame always prevails over the lower one, and you should first look for these, especially the levels, or, I don't know, patterns. Start with the daily, weekly, daily, hourly, 4-hour charts, and only then, maybe move on to the lower time frames, like intraday trading, if you want to. But in general, for intraday trading, it's better to use indicators, and preferably modern ones. They work much more efficiently. The third mistake is probably also about being hasty, actually, or something related to that. I call this kind of mistake, well, I'd probably call such people undertrained or half-learned. They can't be bothered to learn the basics, so they look for some schemes online, miracle indicators, and think they found the holy grail. That's it. Now it's only profit from here on out. But the key word in a trading strategy is actually strategy. And even if you find a really good indicator, that alone won't be enough for success. You need to tweak it somehow to actually make a profit. And it's actually good if someone is unlucky right away, they just get disappointed and delete that indicator. Although, by the way, it might have actually been profitable. At least the person didn't lose a ton of money. But sometimes people get lucky, and then they end up getting into debt, selling their apartments, betting everything just to play on the stock market. But the stock market isn't a game at all, it's a job. And not understanding that this is a zero-sum game, that if you want to make money, someone else has to lose that exact amount, will lead to you being the one who loses. It's like in Texas Hold'em, if you sit down at the table and after 2 rounds you can't figure out who the fish is, then the fish is you. Treat the market responsibly. If you want to trade, it's possible. You can make money through trading. That's guaranteed. Just don't stop, keep learning, keep figuring things out. Understand what you're doing. Don't believe in some single strategy that's supposedly going to pull you into a happy future. Maybe that's possible, but then it should be your own strategy, one you've created for yourself, based on your experience and understanding of the situation. The fourth mistake is gambling. I get it, everyone wants to make all the money in the world right here and now, to buy in at the very bottom and sell at the very top. Honestly, I want that too. But that has little to do with real trading strategies, which, more often than not, don't even try to catch, say, falling knives, that is, the absolute bottom. Let me show you in practice. So, look, we're on the Lukoil chart. This is the 4-hour time frame. That's actually a pretty serious chart. I mean, it's not 15 minutes, not some intraday stuff like that. We saw a small drop and then some kind of bounce, maybe a reaction to the support level here, in this consolidation area. Again, maybe it's oversold or something. That's it. So, you could enter a trade here. And let's say someone enters right here and puts their stop somewhere around here. In principle, that's a logical order. And then what happens next? Boom! He gets stopped out. It even stops him out lower. Well, let's say you didn't enter here. Maybe because, I don't know, maybe I just skipped over that candle. Let's say right here he sees, okay, I got stopped out. And now there's even a divergence showing up. That's it. We're definitely getting in now. And he starts catching falling knives. So, there's still no entry impulse, but he starts catching falling knives. Let's put the stop here. That's it, basically. Now it's definitely going up. We're going to take off from here. The price shot up. Really, it's good if he managed to close here or at least break even. But then, boom. Again. See that? The stop got triggered again. Right here, the stops got taken out. So, the person thinks, okay, fine, they bought it back here. It's a thin candle. I'll enter one more time. I need to get in at the very bottom. I want to. I believe in myself. What happens next? As you might have guessed, there's going to be another boom. You get it? Once again, this person's stops got taken out. This is going to happen from time to time. And so, this trader, who tried to enter right at the very bottom of the deepest valley, just had over about a week of trading, since it was a 4-hour chart. Let's say it was about a week, he had 3 stops taken out in a row. And so it's actually pretty tough. You know, realizing that when you're trying to catch the bottom, you keep thinking, this is the bottom, here's the divergence. And yet the market keeps hitting you from below at that bottom. This happens a lot when you try to catch falling knives. Here's the knife falling, blood red, practically a candle knife. You grab it, it cuts your hand and slips away, falling even lower, hitting a new bottom, and again you get knocked from below. And then this guy, or maybe a girl, this trader who got stopped out 3 times, thinks, well, it's obvious now, the trend has reversed, I guess I should be trading short. And they start looking for a reason to go short. Well, if you look for something, you'll always find it, and here's your reason. Here you go, for example, some level, let's say resistance. The candle hit it. And so, we start shorting. Right here, we open a short position, expecting the price to go even lower. Well, it went down 3 times, so it should go down a 4th time, right? And what happens next? Indeed, the price goes down again, then up, then down, and that's it. And then it left and started going up. It kept going. But by then, it was already without this trader. And this attempt to catch falling knives, or by the way, it could be the other way around, like catching rising peaks. Let's call them that. These ultra highs and ultra lows, it's kind of like trying to sit on 2 chairs at once. On one, there are sharpened knives, and on the other, spinning peaks. You know what I mean? It's pretty much the same story here. Yes, there are trading strategies, and actually, I like trading this way myself, that try to catch those ultra lows and ultra highs. But this strategy is usually for experienced traders, those who are confident in themselves, who've been in the market for more than a year and really understand what's going on. Because, well, regular people who come to the market aren't ready for that many stop losses. They don't know where they should be or how big they should be. And that's why the market often takes off without you, or takes you out with stop losses. And for beginners, I would recommend more conservative strategies, where you don't enter right at the very bottom and you don't take profit at the absolute top. That's almost impossible. Actually, it's probably completely impossible unless you're an insider. Safe entry points look different. I'll have a separate video about that. Subscribe to this channel so you don't miss it. But all that catching falling knives and picking the very top, well, just wait a bit. When you get more experience, you can try playing with that too, but treat it more as luck than as if you really nailed it with some great strategy. And the 5th mistake is probably wishful thinking. This is especially true for those who got lucky right away. That is, they didn't lose their first $100 to a liquidation, like most people do, but things just started going well from the start, and it starts to feel like, well, now it's only going to be success from here on out. I have a 70% win rate. Why should I bother with risk management and only enter trades with 30% or 50% of my deposit? Let me just go in with 5x leverage for a 500% gain. I'll make some quick money now, and then I'll lower the leverage and bring back stop losses later. And of course, everything turns around exactly at that moment, and you get your first liquidation. Trading and technical analysis are work, not a game. I went through exactly the same thing myself. Back in, I think, 2007, when I first started trading and writing trading strategies for trading bots. That was still on Alperi and Forex. I was trading the euro-dollar pair, and I had this cool strategy based on the Arabic indicator WADA. I don't know how that translates or what it means. So, it was a counter-trend strategy. It would build up a position, and then as soon as the trend started to reverse a bit, it would immediately close it. Man, it was an awesome strategy. Back then, I don't even remember exactly. I was a poor student, and I think I took out a loan. Yeah, that's right. I took out a loan. I borrowed my first €1,000 and handed it over to the bot to manage. My friend and I were doing this together. In about a month, it earned us around 400, probably euros or dollars. Honestly, I don't remember exactly what currency it was making money in, but roughly speaking, 400 euros, that's 40% in a month from 1,000, which is, damn, that was awesome. But then, at some point, we noticed it started going into losses, hitting the stop, and the stop was set at $200. It was a shame to lose half the profit, even though we should have just locked in the gains and moved on. But we decided, like, damn, we've got such a genius strategy. For sure, everything's going to be fine. I mean, all the indicators show that everything will be fine. There's just no way it could go wrong right here and now. Nothing is happening. Why should anything go wrong? There's nothing in the news, nothing's going on, and so we removed the stop losses. Alright, by morning everything will be fine. We wake up in the morning, 0 liquidation, minus 1,400 euros in a single night. Greece defaulted. By the way, this is exactly about how the markets always know things a little bit earlier. So, someone was getting out of their position, and we should have just taken our stop at $200 and kept working. But we removed it, because we thought we had it all figured out, like we grabbed God by the beard, but it turned out to be nothing like that at all. And it's not like this is some ordinary event, a whole country defaulting, but here, it happens every day. But the moment you let your guard down, that's exactly when something like this happens. Seriously, not once in the past 10 years had this ever happened before, but as soon as you relaxed and took off your stops, it happened right away. That's why strategies, especially trading ones, especially margin trading, especially with leverage, should always have a stop. If someone tells you there's a strategy without a stop, well, either there's some tricky exit system, or honestly, you should be wary of that strategy, just be cautious. Think it over again, maybe there's another strategy out there. And by the way, that so-called win rate isn't always what matters most. Risk management is more important. Risk management is actually the most important thing in any trading strategy, because I have a trading strategy with a win rate of 40%. That means out of 10 trades, only 6 close as profitable trades. Or rather, actually, it's the other way around. 6 trades are losses, and only 4 out of 10 trades will be profitable. At the same time, the strategy itself is quite profitable. It's profitable because it has a risk-to-reward ratio of 3. That is, the stop loss is 3 times smaller than the take profit. And because of this, even with a win rate of only 40%, it still remains profitable. So never neglect risk management. It's honestly the most important thing in trading. Alright, let's wrap up the introduction here and move on to technical analysis. See you in the next videos. Bye everyone.